Welcome back to Investing Talk Podcast.
Today, we're looking at Oracle.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For years, the whole narrative around Oracle was that it was this sleepy giant, right?
A legacy database company. Generated a ton of cash, but definitely not a growth stock.
Exactly.
Yeah.
That perception, the one that's been baked into the market for, what, a decade? It's obsolete now. What we're witnessing is a really structural reacceleration.
It's all being driven by their pivot into AI and cloud infrastructure.
It's everything. It's the whole story.
That structural shift is really the key, isn't it? It's the difference between just managing a slow decline and actually fueling a whole new cycle of expansion.
It is. If you just look at the top line numbers, the company is growing faster than it has in years.
Okay, so what are we talking about?
Q2 fiscal 26 revenue was $16.1 billion. That's up 14% year over year.
Which is solid on its own for a company of that size. But the real story is what's under the hood.
That's it. The engine powering that number is the cloud revenue. It surged 34% year over year. 34%.
And that's an acceleration, right? I think it was in the high 20s the quarter before.
It was 28%. So when you see a high growth segment of a company this big speeding up, you know something fundamental is in motion.
And it's not just growth for growth's sake. The profit picture is improving too.
Oh, absolutely. The shift to these high-margin cloud services is transforming their finances. We've seen net profit margins expand to, I think, 25.3% over the last 12 months.
The legacy business is stable, it's funding this big AI push, and the overall margin is still going up. That's efficient.
Very efficient. But look, if we want to talk about the real shock and awe number, the metric that just redefines their entire future, we have to look past the income statement.
You're talking about the backlog.
I'm talking about the backlog.
Remaining performance obligations or RPO?
Okay, so RPO. Break that down for us. In plain English, what is that? It's money they've already been promised. Think of it as signed contracts for future work that they just haven't delivered yet. It's guaranteed future revenue already locked in.
And the number for Oracle is?
It's unprecedented. In Q2, the RPO hit a mind-boggling $523 billion.
Whoa. Wait. Say that again?
$523 billion.
That's a number that just doesn't seem real. For context, what kind of growth is that?
It's 438% increase year over year.
438%. That tells you they aren't just signing a few cloud deals, they're locking in huge decade-long commitments.
From the biggest names in tech. And it gives them this clarity that most companies can only dream of. But a third of that RPO, that $523 billion, is expected to be recognized as revenue in the next 12 months.
So that's not theoretical future money. That's high-certainty revenue coming down the pipeline very, very soon.
Exactly. It provides an enormous cushion, huge visibility, no matter what the broader economy is doing.
And we know who's writing these checks. These are the hyperscalers, the AI innovators. We're talking about Meta, NVIDIA.
Yep. Multi-billion-dollar AI cloud deals. And when giants like that commit hundreds of billions in services, it's the ultimate validation. It's proof that their cloud infrastructure, the OCI, can handle the absolute biggest AI workloads on the planet.
And that brings us to OCI. That's the hypergrowth engine we need to focus on.
That's the core of it. OCI revenue grew 68% year over year in Q2. That is a blistering hyperscale rate of growth.
And this is where the ambition just becomes crystal clear. Management guidance, analyst forecasts, they're all pointing to OCI growth breaking 70% in fiscal 26.
And the long-term target they're signaling is, it's breathtaking. They're talking about OCI revenue scaling towards $144 billion by fiscal 2030.
That's not being a niche player. That's aiming to be a top-tier global provider.
To get there, they're being incredibly strategic with their money. We saw them sell off non-core assets, right?
Like their stake in Ampere.
Exactly. That brought in a $2.7 billion pre-tax gain. And that capital isn't just sitting there. It is being plowed directly back into building out this AI capacity. It's a singular focus.
Which is a perfect segue into their competitive position, because this isn't just about spending money. It's about how they're leveraging their history.
Well, their traditional moat was always incredibly strong, built on high switching costs.
Mission-critical stuff. ERP systems, Fusion, their databases. If you're a big company, ripping that out it's a nightmare.
A hugely expensive and risky nightmare. So that's the foundation. But now they've built this entirely new, modern multi-cloud moat on top of it. And this is where their strategy gets really interesting.
The 72 multi-cloud data centers.
Yes, they are physically embedding their data centers inside their competitors' clouds, inside AWS, inside Google Cloud, inside Azure.
Okay, hang on, let's pause there, because that sounds backwards. You're putting your best weapon, your database, directly inside your rival's fortress. How is that a strength?
That is the critical question.
Yeah.
And it's the brilliant part of the strategy. See, the old way forced a customer to choose. You either stick with your Oracle database or you go through this painful migration to, say, Azure.
A terrible choice.
A terrible choice. So Oracle just eliminated it. They said, why choose? Their database anywhere strategy lets a customer keep their critical Oracle database running perfectly while also using the latest AI tools from Google or AWS.
So they make themselves essential no matter where the customer decides to do their other computing. They're turning rivals into partners.
Into their best distribution partners. And the proof is in the numbers. This multi-cloud database business grew an astonishing 817% year over year.
800%. You don't see numbers like that unless you've unlocked a completely new market.
One that was totally blocked by friction before. Now there's no more vendor lock-in argument. Oracle's database just becomes the central nervous system for your entire operation, wherever it is.
And they're doubling down on that with AI integration.
Deeply. Across the whole stack. Infrastructure, the autonomous database, and, crucially, into their big applications like Fusion. The plan is to roll out over 600 new AI agents for enterprise workflows.
So things like automating financial closing or supply chain logistics.
Exactly. And once your key business processes rely on those specialized Oracle AI agents, the switching cost becomes almost infinitely high.
It's a serious lock-in mechanism. But this all sounds incredibly ambitious, and that usually means incredibly expensive.
Which brings us to the elephant in the room, the primary bear case, the massive financial trade-off.
This is where investors get nervous. This is a huge front-loaded investment phase they're in.
Absolutely. The capital expenditures, just the raw spending to build these data centers and get the GPUs they need. It's projected to hit around $50 billion for fiscal 26 alone.
$50 billion in 1 year. And that has to be financed. I've seen numbers suggesting they might add nearly $200 billion in new debt.
On top of the $90 billion they already have.
So, we could be looking at a total debt load approaching $290 billion. How is that not a massive roll of the dice? How do you convince people this isn't a debt bomb waiting to go off?
That is the absolute core tension of this story. Management frames it as a strategic necessity. You have to spend now to capture this decade-long AI demand cycle. If you wait, you lose the contracts.
And the safety net for all that debt is the backlog.
It's the RPO. That $523 billion backlog is the hedge. It's the revenue that is already locked in, specifically to monetize the infrastructure they're building right now.
So the risk shifts. It's not will they find customers. It's can they build it all fast enough?
Precisely. And institutional investors seem to be making that bet. The high ownership, the huge contracts from NVIDIA and Meta.
Yeah.
It's a massive commercial validation that gives big money confidence.
We're seeing physical proof of it too, right? The news about the Oracle OpenAI data center project approvals.
Yes, like that 1,383 megawatt project. That confirms this is real. This isn't just plans on a slide deck. They are building industrial-scale infrastructure at an incredible speed.
Okay, let's pivot to the stock itself, the technical picture. Because with all this transformation, it's been a volatile ride.
It has. Huge long-term trend. I mean, the stock is up significantly year-to-date in some analyses, obviously driven by this AI excitement. But that's come with some sharp swings.
After the Q2 earnings, for instance.
Yeah, the market really focused on that giant CapEx number, the negative free cash flow in the short term, and we saw a pretty big pullback. But a lot of analysts see that dip as a buying opportunity.
A healthy reset.
A very healthy reset. It allowed the momentum to cool off constructively. The stock has maintained a golden cross-like structure, during its run.
And for listeners, that just means the short-term trend is stronger than the long-term average. It's a sign that the underlying structural story is still very much intact, despite the day-to-day noise.
Exactly right. The fundamentals, the contracted revenue, that unique competitive position, they're all still exceptionally strong.
So looking ahead, next 3 months, what are the catalysts we need to be watching?
The single most important event will be the Q3 earnings release. That's expected around March 2026.
And the market will want to see
Confirmation that cloud growth is still accelerating toward that very aggressive target of over 40% for the full fiscal year.
And beyond the numbers, we'll want to see proof they're actually building this stuff.
Correct. Updates on the rollout of those 20 new AI cloud regions, We need progress reports on the completion of the 72 multi-cloud data centers. These are the physical milestones that turn that RPO into actual revenue.
And then there's the macro picture. As always,
As always, any positive signs from the Fed on interest rates would be a huge tailwind. Lower rates just make that massive long-duration stream of contracted revenue even more valuable today.
so if you put it all together, Oracle's strategy is this huge corporate gamble. They're deploying massive capital today, funded by their stable legacy business, all to capture this contracted AI opportunity.
An opportunity that their unique multi-cloud and database position makes very hard for rivals to replicate. The CapEx is the risk, no doubt. But the reward is a complete re-rating of the company into a true AI infrastructure compounder.
So the ultimate question for you, the listener, is whether they can build $500 billion worth of infrastructure faster than the cost of the money they're using to build it. It's a classic trade-off.
High risk today for what could be decades of secured revenue tomorrow. It's a fascinating story to follow.
Absolutely. Thanks for walking us through that. If you want to stay informed on how this aggressive AI build-out progresses, remember to subscribe to the show. We'll see you next time.